Hello, everyone. Welcome to Money Hour Radio, a show where we try to help you grow your money, pay less taxes, and have a beautiful retirement. What could be better than that? I am one of your co-hosts, Ben Barzideh. I have my esteemed, trusted co-host with me, Matt Nadeau here.
Hey, everybody.
And we are both founding partners and wealth managers at Barzideh Nadeau Wealth Management, a comprehensive financial planning firm located right here locally in Barrington. And we are fiduciaries, and as an independent, family-owned firm, we truly have the freedom to focus solely on your interests and not some corporations or those shady private equity companies that are buying everything up these days.
And of course, as always, we want to take a moment, say hi to all of our clients who, we listen to you, listen to us all the time. We really appreciate it. We also appreciate the trust you place in us. Of course, we love every one of you. And Ben, speaking of love, Valentine's Day, right?
I know. Yeah, big day.
I hope you've got some big plans. You don't want to be disappointing Andrea with any
I've got some things
mistakes
cooking
on Valentine's Day.
Yes, I have a fun night planned.
Wonderful. I mean,
How about you? How about you and Trish?
Yeah. I got dinner and hopefully a good gift. So we'll see how that goes.
How romantic.
All right. Well, let's get on to topics that the rest of you care about, not our Valentine's
Love
Day
life.
plans. Yeah. All right. So we're going to talk about jobs, job numbers. This is some fuzzy math that always comes out. We joke all the time. The numbers come out, they revise them, they change them. But let's get down to the bottom line of what these numbers might imply for the economy. It really will be important moving forward to watch jobs, and we're going to kind of dissect what the numbers mean. And then I want to talk a little bit about small caps, mid caps. They're jumping in the Soul Train line, Ben. Soul Train.
We're old when we bring up Soul Train, right?
I guess so.
Yeah.
And then we're going to jump in later where we're going to talk about a really interesting financial planning topic is if you are unfortunately a widow, you're a surviving spouse under the age of 59 and a half, we're going to talk about a dilemma you might have with your IRA. So good stuff. You want to stay tuned and hear all about it.
Before we start, we encourage you to subscribe to our YouTube channel on moneyhourradio.com, where you can view this week's episode along with the previous ones. You can also please subscribe to our weekly economic newsletter that's called the 5-Minute Market Brief. It's informative, succinct, easy to read. You get a really good idea of what we're seeing and what we think is happening, our analysis. You can sign up for that on our website at bnwealth.com. And while you're there, please follow our social media pages on Facebook and Instagram. All right, let's get into it.
Yeah. So let's talk about what these fuzzy math job numbers really are implying for the economy. And by raise of hand out there in radio land, YouTube land, how many of you are confused about all these different job numbers you hear, right?
I am.
Yeah, we are here too. There are not only just one report you're trying to figure out, there's multiple reports. And we can't even know for sure if any of the recent data is correct because it gets revised multiple times over the next few months, maybe later in the next year. And it always seems to get revised down, never up. So not to be cynical, but it is some fuzzy math. And there is a big picture we are seeing, and we want you to know why we think it's important and the potential implications on the economy and the market, but a little more on that in just a minute.
So here are the numbers. Last week, the U.S. labor market released some really bad missed estimates, bad numbers. And it rekindled worries about economic growth, potential recession. First, the Challenger survey showed a huge jump in layoffs, rising to 108,000 from just 35,000 in December. And that's the biggest jump since, get this, 2009, which was, of course, the depths of the financial crisis. The top two reasons for the layoffs were even less comforting as well, with contract losses and market economic conditions topping the list. While, get this, AI only accounted for 7% of the total job cuts. So you can't blame AI on all of it. And details of the release revealed even more concerning numbers as employers reported hiring plans totaling just around 5,000 planned new hires in January. 5,000 jobs, that's not a lot, which was the lowest on record, again, dating back to 2009 when the firm first began tracking this hiring data.
It's always scary when you're referencing stuff that happened around 08, 09 financial crisis. So
of course,
not good. But all right, that was bad news. Guess what? This week, the BLS job report came out, And the headline non-farm payroll rose by 130,000. It was double what was expected and actually the best monthly increase in a year. So, hooray! Like, isn't that great news?
Not so fast. It actually gets a little bit muddier.
All right. So, there was actually a huge downward revision to the 2025 jobs growth, down just 181,000, and it's versus what was supposed to be 584,000 previously reported.
Come on, that's 400,000 jobs.
That's way off, right? And then don't forget last year, the 2024 numbers got revised down by almost 900,000 jobs. So you got to ask, what's going on and who do you believe? And you know what the right answer is, Ben? You know you can believe and trust us. That's right. We're going to try to bring you the real analysis each and every week.
No doubt. And here's what we are seeing that matters. Here's the big picture. Regardless of the actual numbers, they seem to change a lot. The big picture recently has shown that government jobs are declining while the jobs added are all in the private sector. And also, we are seeing a broadening of the participation in the market rally as smaller U.S. companies have outperformed the larger ones over the past few months. We've talked about that before. Smaller regional banks are also doing better. So there are signs that not only is Wall Street doing well, but finally Main Street is starting to participate in it, which actually is going to lead us to our next topic.
Yeah. And that's all good news. Like, we want to see a broadening out where these smaller companies are adding jobs and participating better. And that's really, like you said, Ben, why we want to talk about these small and mid-cap companies. And I know I made a reference earlier, but I know we aged ourselves, but who remembers that old musical TV show Soul Train? And maybe busted out in a Soul Train at a wedding or a celebration. Well, guess what? After years of big wig dominance powered by tech, the little guys and the middleweights are finally having their moment in this Soul Train line, moonwalking right past the big guys. So for years, large caps have actually flexed their muscles. But over the past few weeks, we've started seeing small cap indexes, and now finally the mid caps have also quietly begun outperforming their larger siblings. And there really is a ton of runway left, in our opinion.
And here's where we currently see opportunities. We see opportunities with small caps and mid caps over large caps, value over growth, and cyclical sectors like consumer discretionary, energy, industrials, financials, and materials. These are the areas we like, and guess what? Many of them actually lagged last year, so they're turning the corner now. We can also add to what we like hard assets, commodities such as gold, silver, copper. They're surging. We could actually be what we view, in our opinion, in the midst of a multi-year super cycle for commodities. We'll explain that in future shows. We also like the international areas, both developed international and emerging markets. Guess what? They both outperformed the S&P 500 last year for the first time in many years, and they're doing well this year as well.
Yeah, and when we talk about all these things, we don't always recommend everything we're talking about. But for those of you who listen, you know we have our advance and protect process, the models that we actively manage for our clients. And these are areas that we are currently invested in. We move our allocations towards areas that we see in the market with momentum and strength. And as that trend changes, guess what? So do our allocations. We're not going to just blindly diversify in everything. We want to find the areas that have momentum and adjust to them. And we haven't taken our foot off the gas. In fact, when we look at our growth-oriented models, we are pedal to the metal, 100% equities, and we have been for months. And of course, that led to having a fantastic year, making money for our clients in 2025. And so far, so good, off to a good start for 2026.
However, we actively monitor our investment positions every single day. And if the market conditions deteriorate, we will get defensive by actually selling out of the stock market and going heavier into bonds or cash while we wait for things to improve. And we don't believe in riding potential market crashes all the way down to the bottom and watching money dissipate. And we feel if you're in retirement, it's paramount to have a disciplined sell strategy to exit the stock market and protect your money if the risk of a market crash gets too high. And guess what? The best time to have one is before you may need it, while things are still fine in the market, not after a crash where it could be too late.
Don't wait too long, because you need to ask yourself this question. Do you have a defensive plan to protect your money when you need it we feel you should. So if our investment philosophy resonates with you, you're looking to have your money managed like that, please reach out to us and schedule a complimentary consultation. Not only will we go over our investments, but we'll talk about your current financial situation, your goals. We'll help you with any kind of strategies we can think of. And if we can't help you, that's great. We'll part friends. But if we can, it'd be nice to hear about it. So to explore becoming a client, reach out to us at bnwealth.com or call our office at 847-780-2980. Don't go away. When we come back, we're going to talk about surviving spouse IRA dilemmas. All right, welcome back. Thank you for tuning in to Money Hour Radio, a show where we try and help you grow your money, pay less taxes, and of course, have a beautiful retirement. I'm one of your hosts, Matt Nadeau. I have with me my trusted co-host, Ben Barzideh.
Hello, everyone.
And we're both founding partners, wealth managers at Barzideh and Nadeau Wealth Management. We're a comprehensive financial planning firm located right here in Barrington, and we're serving the greater Chicagoland area. And of course, we like to give back. We value giving back and trying to make our community a better place. And that's why we've launched the charitable arm of our company. It's called BN Giving. It's a way for us to invest in your purpose with you.
Here's how it works. If you become one of our clients and you're a faithful tither or a regular giver to a charity, as long as it's a qualified 501c3 charity, just let us know. Each year, we will match your donation up to 10% of the management fee that you pay us. And as our firm grows, so does the collective positive impact that we can have. It's such a neat concept. It's unique to our firm. We're very proud of it. By the way, if you're not a regular giver, that's okay too. Many people aren't. We'll still be honored to work with you. To explore how you can join our BN Giving community by becoming a client, reach out to us online at bnwealth.com or call our office at 847-780-2980.
All right. Well, let's jump in and talk about some of these topics. This is called if you're under 59 and a half, you're a surviving spouse and you have an IRA, what a dilemma you might run into. And when you are in this situation and your spouse passes away, you face not only the emotional loss and what you're dealing with all that, but there's also complex financial decisions that come along with it. So one of the ones that often get overlooked is if you're a surviving spouse and you're under age 59 and a half. And one of the most important decisions you need to make is how to handle any retirement accounts, specifically ones that are inherited from a deceased spouse. So the choice is between, do you complete what's called a spousal rollover, or do you maintain that account as an inherited IRA? And the choice there can have significant tax and penalty implications. Now, in many cases, keeping the account as an inherited IRA, at least until you reach age 59 and a half, and at that point, completing what's called a spousal rollover will offer you usually greater flexibility and could potentially avoid costly penalties.
No doubt. So understanding the two options. When a surviving spouse inherits an IRA, the IRS provides two primary options. First is a spousal rollover, which means treating the IRA as your own. And by the way, the only person that can do that is a surviving spouse. So surviving spouse transfers the inherited IRA into their own IRA and treats it as if they were the original owner. Then the second option is the inherited IRA or the beneficiary IRA. And the surviving spouse keeps the IRA titled as an inherited account. And it's got a funny name. It goes like this, for instance, John Smith, deceased IRA for the benefit of Jane Smith, beneficiary. So that's the titling of it. And while both options preserve tax deferral, the key difference lies in how distributions are treated, especially before age 59 and a half.
So let's talk about the early withdrawal penalty issue. So if a surviving spouse completes a spousal rollover and treats the IRA as their own, the account becomes subject to the standard IRA rules. You still have an IRA, it's yours now. And that means withdrawals taken before age 59 and a half are generally subject to a 10% early withdrawal penalty in addition to ordinary income tax. So by contrast, if the surviving spouse keeps the account as an inherited IRA, now these distributions no longer are subject to that 10% early withdrawal penalty, no matter how old you are. So it doesn't matter at that point. This is a very critical decision. So let's say you're 52 and after your spouse passes away, you need $50,000 a month out of their IRA to cover the living expenses that you have. The IRS could then grab $5,000 right off the top of that, and that's in addition to the income taxes you normally have to pay on the distribution. So if you're a surviving spouse under age 59 and a half who needs access to funds for living expenses, debt repayment, mortgage obligation, children's education, all these different things, avoiding that 10% penalty can preserve thousands and thousands of dollars. The inherited IRA structure does provide flexibility during this often uncertain period of time that you have while you're going through this.
It can also provide some cash flow and financial stability. And the death of a spouse, of course, often results in reduced household income, even when life insurance or survivor benefits are available. The surviving spouse may need to supplement income temporarily while adjusting to new financial circumstances. And maintaining the inherited IRA allows the surviving spouse to do the following. 1, take penalty-free distributions as needed. 2, spread distributions over time for tax management. And then 3, preserve as much of the tax deferral balance as possible. And of course, this flexibility really acts like a financial safety net.
And there's another thing you really need to stop and think about. These accounts come with a special ticking time bomb that the IRS has, the required minimum distribution. And you got to think this through depending on the two different accounts. Inherited IRA rules have different rules regarding required minimum distributions. So a surviving spouse who keeps the account as an inherited IRA, they are allowed to, in many cases, delay the required distributions until their deceased spouse would have reached that required beginning date, right? So that's one of those situations you may be able to avoid it. There are circumstances to look at. However, once that surviving spouse moves the money into their own account of spousal rollover, now the rules are all based off of your own RMD schedule. Now, this may not be immediately relevant, let's say if you're under 59 and a half, but it can be some important strategy in long-term retirement planning, especially if there's some differences in ages there that you want to coordinate with.
So here is the strategic approach. Here's how is the best way to do it in most cases. First, do the inherited IRA, and then you do the rollover later. So for many surviving spouses under age 59 and a half, the best thing to do, the most strategic approach is first open and maintain the account as an inherited IRA. Use it as a flexible income source if needed without triggering early withdrawal penalties. And then once you reach 59 and a half, complete a spousal rollover into your own IRA. And after age 59 and a half, guess what? The 10% early withdrawal penalty no longer applies to the distributions from the survivor owner's IRA. So at that point, consolidating the inherited IRA into a personal IRA really simplifies management and aligns the account fully with the long-term retirement planning goals. And this staged approach combines two things: short-term flexibility with long-term efficiency.
And it's really important when you're a spouse, you're the only person who can take advantage of these kind of strategies, this flexibility. So when you're a spouse, especially your surviving spouse under the age of 59 and a half, you don't need to rush into making that IRA yours by moving it into your account. It might, feel emotionally right. You might think that's the right decision, but financially it might be costly. So what you want to do is really take the time to understand which is the right decision for you. So making the right choice at the right time can help you preserve wealth, can help you reduce taxes, could also provide financial stability, especially in a time when you're dealing with these other challenges during this transition. And of course, as we talk about all these things, with any financial planning, investing, tax, any planning strategies, it is essential to work with a qualified professional who understands these concepts and can actually work with you to tailor them to your situation. So usually a good financial planner like us acts as the quarterback of the plan and helps coordinate it with other professionals like your attorney and your CPA.
And if you are in need of a knowledgeable financial planner, someone who will put your interests first, we would be honored if you gave us the opportunity to talk with you. If our investment and financial planning philosophy resonates with you, then please reach out to us and schedule a complimentary consultation. We will go over your current financial situation. We will go over your goals. We can also provide a financial checkup. This is a meeting where we can analyze your insurance, taxes, estate plan, your investments. And if things look good, guess what? You will gain a lot of peace of mind. And if there are holes in your plan, then guess what? you will know at least what areas you may want us fix. And many people we talk to have never really had anyone look at all areas of their financial plan, their financial life at one time in one meeting. So that's what we can provide and offer to you. If we can help you, that's great. And as we always say, if we can't, that's great too. That's fine. We will still part as friend. So to explore becoming a client, please reach out to us online at Be in Wealth or call our office at 847-780-2980. And speaking of that, actually, we're having for our clients, we're having a big event later this month. It's our beneficiary party where we have rented out a country club. We have a really fancy dinner. We'll serve some wine, but we've invited our clients to come along with their beneficiaries, people that are going to inherit their assets, because it's very important first to make sure that whoever's going to inherit your assets knows where they are, is comfortable and familiar with the financial advisor that's managing it. But two, there's also all kinds of tax and financial planning considerations that arise in that transfer between one generation to the next. And it's very important to know those rules and conditions ahead of time. For instance, that's something that we provide for our existing clients as well. So again, to explore becoming a client, reach out to us, beinwealth.com, or call our office at 847-780-2980. All right, we're out of time. God bless you. We'll see you next week.
Take care, everyone.